this lesson, we're going to learn what is the exchange rate, what a base currency is, and what is a counter currency. What is the buying price and selling price, the difference between those currencies? What is a pip and how it's calculated? Why are commissions in the Forex market lower than commissions in the stock market? What are the acceptable spreads in the Forex market? What is position and what is leverage? Currency pairs and buying and selling rates. In foreign currency trading, there are always currency pairs, the base currency and the counter currency. Now, the base currency, it is in essence our product. It is denoted on the left side of the pair. We always buy or sell the base currency. The counter currency, well, that's the means of payment and is denoted on the right side of the pair. In a transaction involving the euro-US dollar, I buy or sell the euro against the US dollar, wherein the means of my payment is the US dollar. The exchange rate is the price of 1 unit of the base currency in terms of the counter currency. Let's take a look at the euro against the dollar. 1 euro is equal to $1.5220. The spread. A spread is the difference between the buying price and the selling price, and is the commission which you pay as a currency trader. For example, if, for instance, you want to convert dollars to euros at the bank, they're going to tell you that the buying price is 1.56 and the selling price is 1.49. In other words, in order to buy 1 euro, you have to pay a little more than $1.50 US. If, in that very moment, you want to sell your euro to the bank will buy 1 euro at a price slightly lower than $1.50 of a US dollar. So, if you sold 1,000 US dollars to the bank, you'll receive 641 euros. By selling the euros back to the bank, you're only going to get 955 US dollars. Now, you paid 1,000 US dollars and received 955 US dollars. So, where are the other $45? This is the profit of the change store. This is the commission they charge from their customers. A pip. Another important concept in the Forex market is the pip. Pip, singular, or pips, plural. In the Forex market, the exchange rate rises by pips and falls by pips. For most of the currencies, the pips are denoted 4 places after the decimal point. In other words, if the euro-dollar rate is 1.5220, then the number of the pip is 0. If the exchange rate was previously 1.5220 and now it rose by 1 pip, the exchange rate will be 1.5221. If the exchange rate fell by 10 pips, it would be 1.5210, and so on. The Japanese yen is different. For the Japanese yen, the pip is denoted at 2 places after the decimal point, meaning that if the US dollar Japanese yen is 88.57, then the pip is equal to 7. If the exchange rate rises by 3 pips, it will be equal to 88.60. And if it decreases by 27 pips, the exchange rate would be 88.30. Value of pips. Let's now learn what is the value of every pip within the confines of a particular transaction. If the exchange rate of the euro to dollar is 1.5220 and you want to buy 100,000 euros, how many US dollars do you have to pay? 152,200 US dollars, of course. A second passes and the exchange rate rises to 1.5221. By how many pips did the exchange rate rise? By 1 pip. And what is the current value of 100,000 euros? 152,210 US dollars, which is $10 more. The value of 1 pip in a transaction of 10,000 euros is 1 US dollar. In other words, in a transaction of 100,000 euros, each pip has a value of 10 US dollars. And in a transaction of 1 million euros, 100 US dollars. How are pips calculated? We take the amount of the transaction that we have performed in terms of the base currency and divide by 10,000. This is the value of 1 pip in terms of the counter currency. For example, for a transaction of 100,000 euros, we divide by 10,000 and we get 10. This means that the value of every pip is $10. if we execute a transaction of 30,000 euros, every pip is worth $3. For the Japanese yen, the calculation is slightly different. We divide the amount of the transaction in terms of the base currency by 100, and that is the value of the pip. For example, a transaction of $100,000 in the currency pair dollars to yen, we divide by 100, and the result is 1,000 yen. Assuming that the exchange rate is 88.00, we divide the 1,000 by 88, meaning 11.36 US dollars per pip. Size of the spread. Do you know what the accepted ask-bid spread is for the euro to dollar exchange rate? 3 pips. So in order to perform a transaction of 100,000 euros, which is equal to $152,000, how much commission must we pay? Well, if every pip is equal to $10 in a transaction of 100,000 euros, and the spread is 3 pips, we're going to pay $30 in commission, which includes the purchase and the sale. Commissions. If we compare the commissions rate paid in the stock market, we'll notice that in the Forex market, the commissions rate is very low. For example, in a 10,000 euro trade, the stock's commission is 0.5%, hence 50 euro. In the Forex market, however, you'll pay only $3 commission for a 10,000 euro trade. For a 100,000 euro trade, you're going to pay only $30 commission, and so on and so forth. Now let's look at this in terms of the Forex market. If you expect the exchange rate of a currency to rise, you're going to buy it. If you expect the exchange rate of a currency to drop, you're going to sell it. The sum which you profit or lose depends on the volume of the transaction which you perform. The greater the transaction is, the more you can profit, but you're going to take on a greater risk. And the smaller the transaction is, the smaller the profit will be, but you'll have taken on a smaller risk. Trading currencies is exactly like buying and selling wood, tomatoes, or cucumbers for that matter. We buy the goods when we think the price will rise, and we sell the goods when we think the price will fall. Transaction position. In order to complete a transaction, we need to perform a purchase and a sale. If a purchase and a sale were not performed, then the transaction was not completed, and it doesn't matter if you're going to gain or lose in the course of the transaction. Now remember, this is an important rule. Realization of the gain or loss occurs only when the transaction is complete. Position is in essence a transaction. The opening of the position is the opening of a transaction for a currency pair. The open position is a position which hasn't yet been closed. In other words, the transaction has not yet been completed. And a closed position? Well, that's a transaction which has been completed and the actions of purchase and sale have been performed. Should you leverage? Later on, you will learn whether it's worthwhile to leverage your transactions and by how much. But one must always remember, for whoever wants to leverage, the option is always available, but it's risky. When there is a leverage of 300 times, you can perform a transaction of 300,000 euros as well. And if the price rose by 100 pips, you can even earn a 300% return in one day. But if the exchange rate decreases by 33 pips, you've lost your whole investment. Why do the firms allow us to leverage? Well, the answer is quite simple, really. It's preferable for them that we perform a transaction of 1 million euros rather than a transaction of 10,000 euros. In this way, the broker earns a commission of $300 and not $3. Later on, you will learn what your interest is as traders and why you shouldn't be tempted to leverage transactions.